Good evening, everyone, and welcome to this month's webinar. It's great to have everybody on. I hope you've had a good day, and I look forward to our time together this evening covering the topic of interest, dividends, and capital gains, the taxation of those sources of investment income. For those who don't know me, my name is Jonathan Tucker. I'm the Managing Director of Tucker Professional Corporation. We are a boutique firm that deals just with healthcare professionals primarily. And so our content this evening will be directed to that group. So welcome everyone. As we proceed, if you have questions, please feel free to use the chat feature to post your questions. Mustafa, who's moderating, will get to those and we'll have a Q&A at the end. All right, let's get started. A word about the material this evening, just so you're aware. The materials covered off in today's webinar is accurate as at the time of presentation. The illustrations used in the materials are for educational purposes only, so please be aware of that. Don't take the materials that I have here and then use them in your own situation. You should get professional advice. So just a word about that. All right. Now, why talk about this topic? Why is it important to be talking about it now rather than at other times? Well, recent rising interest rates have really caught people's attention now. You know, a year ago, you wouldn't have thought about putting money into a GIC. Interest rates were low, and so it's the rapid increase in interest rates that we've seen this year that has all of a sudden captured interest around putting money on deposit again, earning interest income. And so that's the backdrop that has brought this topic in particular to the attention of so many people. But just while on the one hand, people are now able to make a reasonable amount of interest for those that are drawn to safe, secure, guaranteed investments like GICs, guaranteed investment certificates, what people oftentimes don't realize is that the tax cost on different types of investment income is different. Not all investment income is taxed equally. And so that's what we'll be talking about this evening, partially, and you can see the other topics that are also on screen we'll be going through. But it's the tax consequences of these different sources of income that we'll want to look at this evening. Now, accountants and lawyers, we oftentimes forget that our clients don't understand even the basics of things that we take for granted. So I wanted to first make sure we're all on the same page, that each person has an understanding when we talk about interest, when we talk about dividends, when we talk about capital gains. What are we talking about here? They all have something to do with investment income, but how do they work? And so when we talk about interest, that's income that is generated when you lend your money to a borrower. We oftentimes don't think of the bank as a borrower or the government as a borrower. Or maybe you've got some extra cash that you make available through a law firm to lend out for mortgages. So interest is the income that is generated when you make your money available to a borrower. All right, so that's the first type of investment income. The second is dividend income. So what is dividend income? What is a dividend? Well, a dividend is the amount that you receive in your capacity as a shareholder. If you don't own shares of a company, you can't earn dividend income. So dividends are a distribution of that company's profit. You own a share in a bank. As it makes money, it pays out dividends out of those profits to its shareholders. Now, you'll notice I've said here, the tax rate on dividend income is generally lower than that of interest. Why is that? Why would that be? Why aren't they treated the same? Well, the reason is because a dividend, which you get when you own a share, is a distribution of after-tax profits. The bank has earned its money, it's paid its tax, and now what's left over after tax is now paid out to its shareholders. So you get a dividend. But the bank's already paid some tax. So why should you pay tax or be double taxed effectively as an owner of that bank? And so for that reason, then dividends are taxed at a lower rate than interest is, because part of your tax has been paid by the corporation. So that's a dividend, and that comes because you own a share. Now, what is a capital gain? A capital gain is the amount you receive from the sale of something you own. You own a stock. You own US dollars, for example, a currency, or a mutual fund, or ETFs, or jewelry, or cryptocurrency, or a vehicle, or collectibles like artwork. You buy it for $100 and you sell it for $200. You make a capital gain. Now, as we will see, capital gain is treated differently than interest income and dividend income. So that's also to be kept in mind. All right, here's a skill testing question for you. You'll see on screen, these are tax rates, tax brackets that each of us, as we earn our income, fall into. The more we make, the more we pay in tax. On the assumption that we're dealing in a scenario where somebody is earning $220,000. This is incidentally, I've set this scenario for someone who's in Ontario, but the rates will change across the country. But for somebody in Ontario, for example, earning over $220,000 of income, that's the scenario. Look at the different rates of tax. Now, this column here, this column represents interest income, employment income, rental income. You have some property, you rent it out, you earn rental income. This column here, we would normally title ordinary income. And so for somebody who is earning income of $220,000 or more in Ontario, every dollar that you earn in that bracket, in that category of income, is taxed at 53.53%. All right. And then that includes interest. So that's the column that somebody earning interest income is going to pay tax on. They're going to pay tax at that amount. Now, if somebody owns shares and they're earning over $220,000, they're going to pay tax on either of these two rates. Now, if you own shares of the bank, you're going to pay tax at 39.34% on dividend income earned. All right. And then capital gains, over here, 26.77%. So here's the skill testing question. If you earn $1 of investment income, what type of income would you rather it be? Interest, dividend, or capital gain? Well, if you said capital gain, you'd be right. Interestingly, just so you know how capital gains works, look at this. It's half the rate of this. If you actually did the calculation, you would find it is literally 50% of ordinary income. Why is that? Well, a capital gain, if you earn $100, you only report $50 of that $100 gain on your tax return. All right. So then, of course, the tax rate of 53.53% is applied, but it's applied only to half of the gain or half of the income. So you make $100, but you only report $50 of it on your tax return, and then you calculate the tax. And of course, the tax is on half of it, and so therefore the tax rate's 26.77%. Another type of investment income. Now, take a look at this. If you were to earn $1,000 before tax is taken into consideration, there are three scenarios here. This is why I like to point this out to clients, because oftentimes investment advisors will say, look at the great rate of return that we got you. Look at the dividend income, look at the interest income that we were able to earn for you. And it's always cast in a pre or before tax rate of return. But for somebody who is earning $1,000 of investment income, if they earn it in the form of interest, they're left with $464.70 after tax. More than half of that has gone in tax, $535.30. If a person earns dividend income, they're left with $606.60. If somebody earns $1,000 pre-tax and it's taxed as capital gains, they're left with $732.35. I'll bet many of you on today's webinar weren't aware of the impact that tax has on your after-tax investment income. I mean, it's substantial. Put another way, you would have to invest $20,000, a little over $20,000 to earn that $464.70, because the amount of tax is such that you would have to have more invested in order to earn the same $464 we looked at in the previous slide, this amount here. So if you want to consider just how expensive tax is and how much money you have to invest, then look at it this way. To earn it, if it was to be earned for dividend income, you'd only have to invest $15,646 to get the same $464 after-tax return. And of course, if it was in the form of capital gains, then you'd only have to invest $12,944 to earn the same $464. So when you're looking at your investment income, don't be fooled by the pre-tax rates of return. You should be looking at it on an after-tax basis, taking that into consideration. Now, I mentioned about capital gains a little earlier on. Capital gains are taxed lower than ordinary income, as only 50% of the gain is included in your income. And this is known as an inclusion rate. So if you earn $1 of employment income from work, you earn $1 of income from interest, you have to report the dollar, the full dollar. So the inclusion rate on that type of income is 100%. Whereas for capital gains, the inclusion rate is only 50%. Now, this is something to keep in mind in the future. If you hear in a future budget released by the government that they're increasing the tax on capital gains, they would do that by increasing the inclusion rate. That's happened before. In the 90s, under the Conservatives, this rate was 75%. So if you made $100, you had to report $75 on your tax return. Currently, if you make a $100 capital gain, you only report 50% of it. So this inclusion rate can be subject to change. Historically, it's gone between 50 and 75%. So just be aware of that. As I say here, it's been 66 2/3 and also as high as 75%. All right, so that's the tax consequences of interest and dividend and capital income that just distinguishes or highlights the different tax treatments, the different tax costs associated with that. Now, let's go on to then the next part. So you earn $100 of interest income or dividend income or capital gains, but are there any expenses that can be claimed to reduce that income? And if so, what are they? Well, yes, you can. And here's a list of the typical expenses that get claimed against investment income. Fees to manage your investments, but just bear in mind, these are fees that we're talking about with respect to accounts that are not registered accounts. When I use the term registered accounts, I'm talking about registered retirement savings plans. I'm talking about registered retirement income funds, pooled retirement pension plans, or tax-free savings accounts. So these types of registered accounts, and by that, I mean the investments are sheltered from tax so long as the money's inside these registered accounts. That's what we're talking about here. So those types of accounts, if you're paying fees to manage those, you can't claim those management fees. But for non-registered accounts, just your regular investment accounts, to the extent that you're paying management fees, those fees can be claimed as expenses. You can also claim fees for investment advice. You can claim bookkeeping fees. So if you've had to pay the brokerage firm to give you reports or account for things, those fees associated with earning investment income are deductible. In some cases, income tax return preparation fees are also deductible. Most interest paid on money borrowed to try to earn investment income, such as interest income or dividend income, we'll talk about capital gains in a second, that expense of interest can also be claimed. And then to the extent that you've got legal fees incurred in the course of earning investment income, that those fees can be claimed also. So when would you have legal fees? Well, if you're lending out money in the form of mortgages, you're going to have legal fees to register in terms of putting those contracts in place potentially. So any of those costs would be deductible. Now, because capital gains is a different beast, then the government says, hey, hold on, what are you trying to earn here? Are you trying to earn investment income in the form of dividends or in the form of interest? Because if you are, we'll let you claim these expenses, the ones that we've looked at here. But if your purpose is to earn capital gains, we're not going to let you claim the interest, for example, on earning a capital gain. Let me give you an example. Supposing I look at a stock and I think to myself, you know what, that stock's a good company. It's Tesla, for example. Why don't I buy Tesla? Because I think it's worth, you know, under $400 right now, but I think it's worth $1,000. So I'm going to buy it. And my motive is to make money on the increase or the appreciation in value. That intent is a capital gain. Now, you might say, yes, but look, I got this interest expense. I borrowed money in order to buy the stock. Surely I should be able to write off that interest, but not with capital gains. As you can see from the note below, if the earnings from the investment are producing capital gains, then the interest paid to earn the capital gains can't be claimed as an expense. Seems unfair, doesn't it? Well, the government's rationale isn't actually all that unfair. The government's rationale is this: we're not going to let you claim that interest expense against your investment income and other sources of income, but what we will let you do is we will let you add that cost to the cost of the investment. So if I paid $100 for that Tesla stock as an example, and I pay $10 of interest, I can't claim that the $10 of interest as an expense, but they will let me add it to my cost base. So why do they care about that? Why? Well, when I sell that stock a year from now and it's gone from $100 to $200, then they will then take into account, or they will allow me to reduce my capital gain by the amount of the interest. And that's only fair. Fair because on the one hand, you might want to claim the interest as an expense, but remember that inclusion rate I talked about? You would be claiming an expense at 100 cents when the government says, yeah, but on the gain itself, we're only taxing you on half of it. So add it to the cost of the investment, and then we're treating everything consistently. Both the cost of the investment and the interest you will get deductibility, but at no higher rate than the inclusion rate on the investment. So when it comes to investing for capital gains, then that's the rationale. Now, sometimes you buy a stock that yields dividends as well as appreciates in value. Where it yields investment income in the form of dividends, then the interest can be claimed. It gets a little bit more tricky, but just bear that in mind. All right, so what other expenses can be claimed with respect to investment income? Well, before you ask, here's a list of the things that can't be claimed. You cannot claim the interest on money borrowed to contribute to a registered account. We've already talked about that. You can't claim safety deposit box charges. You can't claim interest paid on student loans, although depending on the student loan and the nature of it, if it's registered or not, there is a tax credit that may be available. Subscription fees paid for financial publications cannot be deducted. Now, there is a tax credit for publications, but that's different. But as a deduction, subscription fees for financial publications can't be. And then brokerage fees paid at the time of purchase or sale of an investment, those can't be claimed as an expense. They're like interest. The costs get factored into the calculation of the capital gain, but they're not a deduction in the same sense as the other. All right, so we've talked about the tax consequences of interest, dividend, and capital gains. We've talked about the deductions that can be claimed to reduce investment income. Now let's talk about then what are some tax efficient strategies when it comes to earning investment income. After all, you might infer from what I'm saying that what I'm suggesting is that you should not earn interest income, or you should not earn dividend income because it's taxed at a higher rate than capital gains. So, but that is not what I'm saying. I'm not saying, and I'm not trying to do your investment advisor's job. I'm just trying to make you aware of the different tax rates. So what are some strategies? Well, earn interest income, because that's part of a balanced portfolio. Earn your interest income inside of an RSP, or inside of a tax-free savings account, or inside of the new program, the first-time homebuyer savings account. Those accounts are not subject to income tax, not at least immediately. So that would be the place, that would be the type of account that you would want to use to earn your interest income versus earning it in a regular savings account, for example, or earning it in your investment account that's not registered. So first tax planning strategy is earn your interest income inside of a registered account rather than outside of those registered accounts. Second, earn your dividend income inside of a registered account. Now, this is a little bit more tricky, and I'll explain why. But if you are going to earn dividend income, it would be better from a tax efficiency perspective to earn it inside of a registered account for the same tax deferral reasons I mentioned about interest. But you've got to keep in mind too that, and we'll get to this a little bit later, sometimes stocks decrease in value. And if they're held inside of an RSP or inside of a registered account of some sort, those losses can't be claimed in the future. More on that in a few minutes. Third point, earn your capital gains income inside of non-registered bank or investment accounts. In other words, earn your capital gains in an account that isn't an RSP or tax-free savings account or a first-time homebuyer savings account, for example. Earn it outside of those. All right. Fourth, avoid making high-risk investments inside of registered accounts. So what do I mean there? Again, I'm not trying to tell you how to invest your money here. I'm simply, and some of you might be saying, well, hold on, I got ETFs and mutual funds and stocks inside of my RSPs. Are you saying I shouldn't do that? I'm not saying that. I'm saying that if we're trying to be as tax efficient as possible, earn the capital gains outside of a non-registered account rather than inside. But if you have investments inside of those registered accounts, that's okay. The point I'm making with point 4 is just make sure where possible they're not high risk investments. They're not penny stocks. They're not ones that you could lose all of your money or a substantial amount of it. And the reason, as I'll explain a little bit later, is because if you do incur losses on those investments and those losses happen inside your registered accounts, you lose everything. You have an entire loss. But if you've got those riskier investments outside of a registered account, if you sustain a loss, the loss actually has some value. In other words, you can earn future capital gains and use up those losses to reduce those future capital gains or even past capital gains. So if you want to minimize your losses as much as possible where you're getting into riskier types of investments, then avoid putting those high risk investments inside of registered accounts. Keep them outside. And the safer types of blue chip investments, put those inside. The ETFs that are safe, the mutual funds that are safe, the stocks that are safe and not likely to incur heavy losses in periods of volatility. All right. Now, there's another option you have, which is where permitted and where it's advisable, and you'd want to get guidance on this because this wouldn't work for everyone, but consider putting cash inside of permanent insurance policies in force. That's another way of earning investment income on a tax-free basis. So, but again, that's a trickier area, and you'd want to get advice on that. So I mentioned that as another possibility. Include your investment advisor in a team call with your accountant well before the end of the year. So part of what we're talking about now, and this webinar is being done in November, is we're talking to a lot of clients about investment planning between now and the end of the year, selling stocks, triggering gains, triggering losses. And you want to do that well before the end of the year when it comes to filing your personal tax positions. And then above all, and I say this knowing that many people who will watch this are administering their own investments. You don't have to go too far to find people who in this market have had substantial losses. So the seventh point in terms of tax efficient strategies for earning interest, dividend, and capital gains income is to avoid investing on your own and always seek the advice of experienced, qualified, and a reputable investment advisor. Okay, so those are some strategies around not putting risky investments into registered accounts, earning interest and dividend income inside of registered accounts so that you don't get hit with the excessive tax that is assessed when it's earned outside. And then capital gains that are risky, keep them out so that if you do lose, you can at least do something with the losses that you incur in that situation. Now, let's talk about an area where there's a lot of planning. Interest. Some people will have real estate. They'll have a rental property, but they'll also have their own home, as an example. You will want to give some thought and get some advice in terms of converting non-deductible interest into deductible interest. Let me give you an example. If I own my home and I own a rental property, I would rather have more debt on the rental property and less debt on my home. Why? Well, remember I said rental income is taxed like interest income. It's taxed at a high rate. You remember, if you're earning over $220,000, then you're taxed at 53.53% on interest income, rental income, employment income, self-employed income. So you will want to reduce that type of income with expenses where possible. The interest on your mortgage on your home is not deductible. So it would be ideal to have more debt, which is attracting more interest on the rental property to reduce the income there, and less debt and lower interest, which can't be claimed as an expense on your personal. So just to keep that in mind, but you need to be careful because there have been many cases on this that CRA have advanced to tax court, and specifically with respect to claiming interest income. But because interest expense can be such a substantial deduction, it's something to consider. If you'd like to talk about that further, feel free to contact me after the webinar. All right, now, so what are some factors to consider beyond just tax consequences? What do I mean by this point? I mean this. Accountants and lawyers, we will always tell you what can go wrong. We will always, well, particularly accountants, if we're dealing with tax, our focus is always going to be in large part on minimizing your tax. And so what I've talked about here this evening is ways to minimize tax. But oftentimes that's confusing to people. They think, well, okay, what's the priority here? Is it investment quality or is it reducing tax? So let me be the first to tell you that the first priority is investments, the investment decision itself. So don't make decisions based on tax, make them on investments. All right, don't let an accountant talk you into an investment because of a tax implication. It should be a good and sound investment, and that takes priority. So let's look at the factors to be considered beyond the tax consequences. I don't want you coming away from this tonight thinking, okay, my focus has to always be first and foremost tax. That's not what I'm saying. I'm just letting you know that there is different tax levels assessed to different types of investment income. So what are the considerations beyond just income tax which should be evaluated? Well, firstly, the return on investment. I said we started out by saying a year ago, people would not have considered putting money into guaranteed investment certificates or saving high interest savings account. Why? Because the return on investment was less than what inflation was. Why would you do that? Return on investment, that is a high priority. The next is risk. So realize that if I say to you, hey, listen, invest some money with me and I'll give you a 20% rate of return. Because the rate of return is so much higher than what you would get if you put it into the bank and earn 5% interest, you've got to realize there's risk with that investment. So the higher the return, the higher the risk. Now, if you're young, you will probably have a longer runway to take some chances than somebody mid-career or late career. So recognize you've got to assess your risk tolerance based on where you're at and whether or not you can sleep at night. But realize that with risk or with higher rates of return goes risk. Next, the investment period. Some investments require that you put the money aside for a long period of time. Guaranteed investment certificate, you'll have to commit that money for a period of time. You won't be able to touch it. Some investments are even longer. Some are before you see anything coming out, it's at least 5 years. So liquidity then, or investment period rather, becomes a consideration. How long am I going to tie up my money? One of the reasons people find the stock market appealing is I can buy it now and turn around and sell it tomorrow and get my money almost instantly. Liquidity then is another consideration. How easy is an investment convertible into cash if I need it in cases of emergency? All right, so you don't want to tie up everything because on the one hand, it looks like you're going to get a great return on investment, but in 6 months you need the cash and you won't be able to get that money inside of a year or inside of a longer period of time. So consider the liquidity. Notice how far down tax is on the list, right? It's the 5th consideration out of what, 8 or 9. So tax, we've talked about the tax cost and the tax efficiencies in the investment. And then the inflation rate. So there is an expression called a real rate of return. What do we mean when we talk about a real rate of return? Right now, inflation is over 6%. If you're earning 5% rate of interest, you're losing ground. The value of your money is eroding at a rate of over 6% and you're only earning 5%. So if you're talking about getting a rate of return, it needs to be a real rate of return. In other words, a rate of return that takes into consideration inflation. So oftentimes I sit on a charity foundation, and we've said to our investment advisors, we need a real rate of return of 5%. Well, what that really means is we need to be earning over 11, recognizing inflation is over 6, just to earn a real rate of return of 5%. So you need to be thinking in terms of real rates of return, taking into consideration the rate of inflation. And then volatility. Right now, we are in precarious times economically. So as you consider investments and the volatility that's going on right now is now a good time to be investing in the market. I met with a client yesterday. The value of their investments a year ago was 2.1 million, just under 1.6 million now. That's how volatile the markets are. Now, he's in it for the long run. He's fine. He recognizes that, there are going to be periods like this, but we don't know how long this could go on for. But volatility is another consideration when making investments. And then your future cash needs. When will you need cash and will it be available? So I only mention this slide to you because if you just listen to me talking about tax or any other accountant, you would think tax is the major determinant in investment decisions. It's one of many. Keep it in proper proportion and and priority. All right, so we talked about the tax consequences of interest, dividend, and capital gains. We talked about the deductions which can reduce investment income and why we do that, and the efficient tax strategies. We talked about interest claimed as an expense and ways of converting non-deductible into deductible or structuring it in that fashion. And then factors to consider beyond just tax. Now let's look at the final part, which is dealing with how to take advantage of your investment losses. If you're investing, you are going to lose money in all likelihood. That is going to happen at some point or other. It's just a factor. Here's an example of how you can take advantage of those losses when they come along. This is an example from the Canadian Revenue Agency. In 2021, Leah sold 2 different securities, which resulted in a capital gain of $300. So you remember we talked about that inclusion rate, that if she made 600, she only has to report 300. That's what they're talking about here. So Leah made a capital gain of $300, and she had a loss of $500. So 2 different transactions. She made money on one, lost money on another. The net outcome was she's down $200. So Leah, as it says here, has a $200 allowable capital loss. The money was not inside of a registered account. This was just security she held in a regular non-registered account. Now, CRA makes this important point. They say that Leah cannot claim the $200 against other sources of income. She can't say, I lost $200, so therefore that $200 is going to reduce my income from my salary, or it's going to reduce my income from interest, the interest income that I earned, or from my medical practice as a sole proprietor. That's not how capital losses work. Capital losses that arise from investment losses can only be applied against capital gains. So they stream these types of losses. They say you can only apply that if you have a gain. So CRA makes this point to say, while she cannot deduct $200 from other sources of income, interest income, dividend income, employment income, rental income, she can't claim that $200 against those. The $200 becomes part of a computation of her net capital loss for 2021. She can apply the net capital loss against her taxable capital gains in any of the 3 preceding years or in any future year. All right, so let's see how that plays out. We'll get to that, but just to be aware, just to reiterate, this is what CRA was saying in that last slide. Losses from the sale of investments can only be used to reduce future or past capital gains. Losses from the sale of investments held inside of registered accounts can't be applied against capital gains in a non-registered account, all right? And losses incurred inside of registered accounts are lost forever. There's no value to a loss inside of a registered account. So we'll come back to this slide in a moment because it talks about something else. But let me show you how this works in real life. On this slide, there are a lot of numbers. It can be a bit mind-numbing. This column here represents a taxpayer's capital gains over years. Here are the years, okay? So you can see they had a good year in 2011. They made $320,000. In actual fact, that's $640 because there is a 50% inclusion rate. So a very good year, okay? And in the next column, you can see losses that they've sustained. Those are aggregated losses. Maybe they had 20 investments and the total of the losses that year is what is enumerated on in this column, all right? And then what they've started to do in this column is they've started to apply those losses against gains. An investor in the long term will take the losses in stride and continue to invest and keep track of those losses. And so that's what we have going on in this slide. We see that while they make money in some years and lose money in others, the losses in some years can then have value in reducing their income tax when they earn back their money in other capital gains in the future. In the far right column, this column here, you can see the available losses after their losses in these columns have been applied. This is what they still have available to use in the future. All right, how does it work? Here's an example. This is a person, you're seeing 5 years of their tax history. What I'm drawing your attention to is the highlighted area here. So in 2021, they had capital gains of $8,533. It formed part of their total income of $79,000. All right, so that's the first thing. Also notice over here, they had capital gains in 2019 of $2,556. All right, you saw those numbers here, 85.33 and 25.56. All right, now they kept track of their losses as they should have. And in 2021, they reduced this gain by this loss. So you can see that they had $8,500 added to their income, and then they had some deductions in here, but they also reduced their income from $79,000 to $66,000 by claiming the losses that had occurred from other years. This is what I mean, that losses can have value when it comes to reducing your income tax. So this is how this works. You can see I've highlighted in this slide the actual application of the loss. The loss is applied, can only be claimed in situations where there is capital gains. If you notice over in 2019, they had $2,556, but nothing was claimed as far as losses because at that point they couldn't. But what they could do is they could, even though it appears in this case that they didn't use it, they could actually take losses if they had earned losses or incurred losses in, say, this year. You wouldn't see the losses. Why? Because remember, you can't claim losses unless you have capital gains. But if they had losses, which they probably did, then those losses of this year could be carried back against this income, and they could file an adjustment and say, please apply the loss from this year against my gain in this year. And they could recover some of the tax that they paid in a prior year. All right, so that is how losses work when you've got investment losses outside of registered accounts. All right, I hope that's clear. I hope that makes sense. We've talked about net capital losses here. There are many different types of investment losses that we could have talked about tonight. I've focused on the ones that are most common, capital losses, or what they're known as for tax purposes, net capital losses. Now I want to talk about how sometimes people use losses to their advantage. Let's go back. Well, let me go forward for a second here. This slide will illustrate the point. This person, before the end of the year, knows how much money they've made in the markets. They get an investment statement every month or every quarter, or they go online to see how much money they've made from selling their investments, their stocks in the year. And you can see they've made $85.53 on their tax return, but they would have known that earlier on, well before filing their tax return. So they say to themselves, you know what? I got some dogs of investments in my portfolio. I have Alibaba, for example. I don't think that's ever going to come back in value. I'm going to sell it. And so they sell it at a loss. Why? Because they want to reduce their capital gain. So that's one scenario. Whereas they say, okay, well, you know what? I'm never going to make money on that. Why don't I sell it now? And then I'll reduce my gain and I'll reduce my income. And that in turn will reduce my tax. That's fair to do. But what if you look at your portfolio and you think, okay, well, Tesla's down right now, and I know I've made money on this stock, and I still like Tesla, but what if I did this? What if I sold this stock tomorrow? And with that loss, because I know what I paid for it, I paid $600 for it, and it's worth $400 now. With that loss, I could then wipe out my gain this year, but I still like Tesla. So I'm going to turn around, and tomorrow after I've sold it, I'm going to buy it back. There are rules in the Income Tax Act that address what's known as superficial losses. A superficial loss occurs when an investment is sold at a loss and then immediately repurchased. So that's what we're talking about now. We're talking about manipulating your income by tax loss selling and immediately buying back the investment because you happen to think that it's still a worthwhile investment. So these superficial loss rules work in such a way as that they don't permit you to claim the loss under certain circumstances. And you can see the diagram below. It talks about a 30-day period before the settlement date or the date you sell and a 30-day period afterwards. The rules are this: if you or somebody that you're related to buys back stocks within a 30-day period that you sold, so you say to yourself, okay, well, I know there's these superficial loss rules, so I can't buy them back, but what if I got my partner to buy them back? Or what if I got my professional corporation to buy them back? These superficial loss rules will act to cancel out the deduction on your personal tax return for that year. But that doesn't mean they're not giving you the loss. They're just saying, we're going to deny the loss this year because you still effectively own that investment. You just sold it and bought it back. But that loss, we will add to the ACB, the adjusted cost base of your future holdings of Tesla. I sold Tesla today. I sustained a loss. I sold it when it was at $400. My loss was $200. So therefore, my real cost in the future on which I'm going to be taxed is the $400 that I bought it back for today, plus the loss that I incurred of $200, which was denied to me. So that's how superficial loss rules work. That will give you roughly an idea of what your parameters are. So if there's investments that you still want to hold on to, be aware of these superficial loss rules and make sure that you don't reacquire them within these holding periods so that the losses are denied. Or if you're thinking of trying to reduce your gains, be aware of these superficial losses if your intention is to buy back the shares, because all you're doing is you're setting up a deferral of that loss from being used in the future, and you're incurring transaction fees to do it. It's not worth it. All right. This will give you a rough idea or at least an overview of some of the things to consider with respect to investment income, whether it's in the form of interest, dividend, or capital gains. What we've talked about tonight is the taxation of those investment sources for individuals. We haven't talked about the taxation of investment incomes inside of a corporation. So beware that what we've talked about tonight will have no application for the investments inside of your corporation. This is just for your own personal investing, not for corporate investments. That topic will come up next month in part 2, the taxation of investment income earned inside of a professional corporation, what to do and what not to do. So that is coming up next month. Now, are there any questions? Mustafa.
Nothing yet. All right, we got a question here. Hold on. So let's say I borrowed money to invest and I own a stock that has a 1% dividend yield, and I expect the stock price to compound at a rate of 9% annually.
Okay.
Would I therefore deduct 10% of my interest payments as an expense and then down the road use 90% of my interest payment as part of my adjusted cost base for the investment?
So I get back to what the original intent of the investment was. It sounds to me like the investment was paying a yield. Correct me if I'm wrong here, Mustafa, because there's a lot of facts in that question. But if I'm investing to earn a yield, in other words, a rate of return, I think you cited a rate of return in there, Mustafa, is that right?
Yeah, there's a 1% dividend yield.
There's a 1% dividend yield. So if that's the case, then part of your intention here is to earn investment income. Now, you might think, well, hold on, I'm paying 5% interest to earn 1% in interest. CRA has said that they're not picky about how much interest or dividend income you're going to earn. It's the intention that's key, not how much you actually earn in the form of dividend income. So in this case, the interest income in the fact pattern you described, I would think could be claimed in full and doesn't get added to the cost base because the original intent is to earn the dividend. It isn't necessarily to see the stock increase. Now, having said that, Mustafa, read that question to me one more time to make sure I've addressed it properly.
Let's say I borrowed money to invest and I own a stock that has a 1% dividend yield,
Yeah.
and I expect the stock price to compound at a rate of 9% annually.
Hmm.
Would I therefore deduct 10% of my interest payments as an expense and then down the road use 90% of the interest payment as part of my adjusted cost base for the investment?
No, you would claim the full amount of the interest income against the as you incur it annually. You wouldn't prorate it between the dividend and the increase. After all, you think it's going to compound at a rate, but I'll bet you if you bought that last year on those assumptions, it wouldn't have compounded. It might actually have gone down in value. CRA in one of their interpretation bulletins has said, we don't care how much the taxpayer earns in terms of their dividend income. As long as there's the presence of dividend income or even interest income, we will allow you to claim that interest cost in the expectation that in the future, then your negative will turn into positive. What kind of clouds this fact pattern is that the person is expecting the value of the investment to go up, and that's the assumption that may or may not actually occur. So I'd rely on the interpretation bulletin. I don't remember the IT bulletin number at this point that deals with that question, but I think that's where I would land on that.
Another question here. So let's say if you sell a stock at a loss, let's say Air Canada as an example,
Yeah.
and 2 days later you buy an index fund that happens to have the Air Canada stock. Would that be seen as superficial?
No, because it forms part of a bundle of stocks that are being owned. What they're getting at with superficial loss rules is, I own Air Canada today. Somehow or other, either me or a related party to me now earns or owns that same stock tomorrow. The fact that you turn around and buy it and it happens, you have no control over what's in that pool of stocks. And I suggest you wouldn't be drawn to buy that particular investment just because Air Canada was in it. So it wouldn't be the same investment. It would be a different investment.
That's all the questions for now.
All right. Thank you, everyone, for your time. I hope you found this useful. If you have any other questions after we're finished here, feel free to contact me. There's
I'm
also,
sorry, Jonathan.
Yep.
Yeah, we just have a follow-up question here. And this is about the first one that we asked. If I previously used all interest payments on debt for investing as an expense, for example, on a stock that didn't have a dividend yield, on my prior tax returns, can this be retrospectively corrected on my prior tax returns?
Well, I don't know if you've claimed part of your interest. If you actually claimed, the pro rata share of it, I think I'd want to look at what was actually filed on the tax return. You could, I suppose you could go back and indicate that there had been carrying charges incurred that hadn't been claimed, but you would want to make, now then that would depend on if you had then subsequently sold any of those investments and claimed the interest on the cost base of the share at the time of the disposition. So you can't double dip, you can't claim the interest as part of the cost base and also the interest as a carrying charge. So you'd have to check those things to make sure you weren't double counting. If you had, then I'd suggest you've already taken your filing position. If you hadn't, then perhaps you could go back and say, listen, I have interest charges here I haven't claimed in full and I'd like to get credit for it. Bear in mind too, there's a statute period for going back and amending. So you'd want to keep that in mind as well. All right, I think we'll call it there. Again, thank you everyone for joining us today. If you want to watch this video, there will be a recorded version of it. And on screen, you can see the location of it on our website, as well as other on-demand webinars that or on-demand videos that we've had in the past. So feel free to avail yourself of those. Again, thank you for your time, and I look forward to seeing you inside of our next month's webinar on the taxation of investment incomes earned in a professional corporation. Thanks so much. Have a good evening.